RKLB jumped 8.2%. Lab scores at 66 out of 100. Why? Their Photon spacecraft bus just booked a $55 million NASA Escapade contract. That's 100% in-house avionics, power, and propulsion. Wall Street still calls them a launch company. The full teardown proves they're already a full-stack space prime. Rocket Lab's hardware moat is dangerously overvalued because its flagship Electron rocket is limited to a payload mass fraction, the ratio of payload weight to total launch weight, of just 2.4%, leaving it exposed to SpaceX's brutal rideshare economics. While Wall Street focuses on Rocket Lab's $2.2 billion backlog and Q1 2026 revenue of $0.20 billion, they are ignoring the physics of rocket propulsion and structural materials. Electron relies on 9 Rutherford engines. These are unique because they use an electric pump cycle, a design where electric motors powered by lithium polymer batteries spin the propellant pumps rather than a gas generator. This eliminates complex turbopumps, but it introduces a massive weight penalty. The battery pack alone weighs over 100 kilograms. As a result, Electron's maximum payload to low Earth orbit, the altitude up to 2,000 kilometers where most satellites reside, is capped at 300 kilograms. Compare this to SpaceX's Falcon 9, which uses Merlin 1D engines running on a gas generator cycle, a system that burns a small amount of rocket fuel to drive the turbine that pumps the rest of the fuel into the combustion chamber. Falcon 9 achieves a payload mass fraction of over 4%. Reusability further widens this gap. When SpaceX flies a transporter rideshare mission, they price it at roughly $2,700 per kilogram. Electron costs about $7.5 million per launch, which translates to $25,000 per kilogram. Rocket Lab is charging a 900% premium for dedicated orbital insertion, the process of steering a satellite into its exact target orbit, because their physical architecture cannot compete on raw mass transport. To survive, Rocket Lab is building Neutron, powered by the Archimedes engine. Archimedes moves away from electric pumps to an oxidizer-rich, staged combustion cycle, a highly efficient closed thermodynamic cycle where all engine exhaust is routed through the main combustion chamber. Archimedes targets 165,000 pounds of thrust, but scaling this architecture is a massive engineering hurdle that requires flawless execution. While the market treats Rocket Lab as a pure launch company, its real survival mechanism is its space systems division. This is the hardware vertical that builds star trackers, optical sensors that navigate spacecraft by tracking stars, and solar panels. In the quarter ending March 2026, this segment drove the bulk of their $0.20 billion revenue, proving they are a spacecraft manufacturer first and a launch company second. The existential threat to this business is Starship, with Flight 12 debuting the V3 Raptor engine, which is 105 kilograms lighter and delivers higher thrust. SpaceX is pushing toward a target launch cost of under $100 per kilogram. If Starship achieves this, it completely destroys the economic justification for any dedicated medium-lift vehicle, including Rocket Lab's Neutron with its 15,000 kilogram payload capacity. To defend its margins, Rocket Lab is aggressively vertically integrating. Their recent acquisitions of Mynaric for laser optical communications, technology that uses light beams to transmit data between satellites in space, and Motive Space Systems for Mars-proven robotics are tactical moves to capture more bill of materials value. They are trying to build an end-to-end satellite bus, the structural frame and primary subsystem of a spacecraft, so they don't have to rely on external suppliers. This is a capital-intensive strategy. Rocket Lab's diluted EPS of -7 cents for the quarter ending March 2026 shows that building this infrastructure is burning cash, even as revenues grow. Today's 8.22% surge to $135.76 is a classic case of a rising tide lifting all boats as the market reprices the entire space sector ahead of the SpaceX initial public offering. But the underlying engineering reality shows Rocket Lab must rapidly transition from a small satellite launch provider to a vertically integrated satellite prime contractor to justify its $79 billion market capitalization. quarterly financials showing modest revenue momentum for RKLB. The dominant macro force driving Rocket Lab is the global defense and communications infrastructure supercycle, acting as a massive tailwind that will monetize their $2.2 billion backlog and sustain their 63.5% revenue growth despite a restrictive 3.64% federal funds rate. Kevin Warsh is sworn in as Fed chair against a rising inflation threat. Wall Street braces for rates to stay higher. With the 10-year yield at 4.57% and the yield spread normalizing at plus 0.49%, the Kalsher recession risk sits at a mere 5.6%. This normalizing curve acts as an economic accelerator. Corporate buyers now have the confidence to commit to long-term aerospace capex. For Rocket Lab, which carries a volatile beta of 2.31, this environment would normally compress valuation multiples. Yet, with CPI at a muted 0.6% year-over-year, raw material input costs are stabilizing. This allows Rocket Lab to protect its margins even as unemployment rises to 4.3%, which cools wage inflation for specialized aerospace engineers. Simultaneously, policy shifts are creating a powerful tailwind. Global trade faces intense tariff uncertainty under the new administration, but domestic defense spending remains an absolute priority. The U.S. government is actively deploying capital to break the SpaceX launch monopoly. This policy priority directly feeds Rocket Lab's massive $2.2 billion backlog. Government agencies are treating orbital access as critical national infrastructure. They are funding programs like Rocket Lab's HASTE program, which recently secured a $190 million Department of Defense block order for 20 flights. The geopolitical reality is that space has officially become the fourth warfighting domain. This shift transforms orbital hardware from a scientific pursuit into a national security mandate. As geopolitical friction escalates across the Taiwan Strait and Eastern Europe, the U.S. military is aggressively pivoting. They are moving away from vulnerable geosynchronous satellites toward resilient LEO constellations. This structural shift is the tide lifting all boats in the new space economy. Rocket Lab, alongside peers like Kratos Defense and AST Space Mobile, is capturing this capital. Kratos recently secured a $447 million Space Force Prime contract, while AST Space Mobile is deploying its massive Bluebird arrays to secure sovereign satellite broadband. Rocket Lab's strategic acquisition of Mynaric for laser optical communications positions them at the absolute center of this military-grade mesh network. This is not speculative growth. It is a geopolitical necessity funded by non-discretionary defense budgets. This geopolitical urgency is colliding with a massive social and corporate narrative shift. The upcoming SpaceX initial public offering on June 12, 2026. The market is waking up to the reality that SpaceX's projected $1.75 trillion valuation is not driven by rockets. It is driven by Starlink's $10.6 billion broadband revenue. This realization is causing a violent capital rotation. Investors are fleeing commoditized software stocks and flooding into hard-tech space infrastructure. Rocket Lab, surging 8.2% today to a $78.6 billion market capitalization, is the primary beneficiary of this retail and institutional FOMO. The public and political backlash against big tech's data monopolies is further accelerating this trend. Sovereign nations demand independent, secure space infrastructure rather than relying on a single private conglomerate. While Wall Street views Rocket Lab through the narrow lens of launch costs, the macro wave is clear. The physical infrastructure of the next century is being built in orbit today, and Rocket Lab owns the toll booths. RKLB is trending higher, currently at 135.76. Part A. Rocket Lab's official narrative is a masterclass in controlled optimism. Management wants you to believe three things. Neutron is on track, Electron reuse is a differentiator, and the company is the end-to-end space company for the AI-driven satellite boom. Their latest investor deck leads with AI demand is accelerating satellite deployment, and CEO Peter Beck's prepared remarks last quarter included the phrase, "We are uniquely positioned to capitalize on the next decade of space infrastructure." That's the glossy PR line. Let's flip it. First, the insider activity. Over the past 90 days, Rocket Lab insiders have net sold 333,449 shares. That's not a rounding error, it's a pattern. When executives sell this consistently, it's not about cashing out for a vacation home. It's about risk perception. Historically, this kind of insider selling in a high-growth tech stock precedes one of two things: either a looming technical hurdle, like a Neutron test failure, or a valuation that's outpacing fundamentals. Rocket Lab stock is up 78.7% YTD, and insiders are selling into that rally. That's not confidence, that's caution. Now, let's decode the PR language. Management keeps hammering the phrase end-to-end space company. What they're not saying is just as telling. They're not saying we're the low-cost launch provider, because they can't. SpaceX's Starship is targeting $100 per kilogram to orbit. Rocket Lab's Electron is $22,000 per kilogram. That's a 220x cost disadvantage. So instead, they pivot to precision, reliability, and vertical integration. That's PR speak for we can't compete on price, so we're selling a premium service. Fine, until Starship's economics force the entire industry to reprice. Then premium becomes niche. And then there's the AI angle. Rocket Lab's investor materials now lead with AI demand is accelerating satellite deployment. That's a linguistic pivot. 6 months ago, their messaging was about defense contracts and lunar missions. Now it's all about AI. Why? Because AI is the only narrative that justifies a $78.6 billion market cap for a company that did $200 million in revenue last quarter. The lab hears this. We need a bigger TAM to justify our valuation, so we're latching onto AI. But here's the reality. AI doesn't need more satellites, it needs better satellites. And if SpaceX can launch them for 1% of the cost, Rocket Lab's end-to-end pitch becomes a liability, not a moat. Part B, let's talk about the numbers that management doesn't lead with. EPS beat by 14.1% last quarter. Impressive, right? Not so fast. That beat came on a 45% R&D spend, $271 million, up 55.2% YOY. R&D is growing faster than revenue. That's not a red flag, it's a flare. Rocket Lab is burning cash to develop Neutron, and Neutron is a $500 million bet on a single rocket. If Neutron fails, the stock doesn't go down 10%, it goes down 40%. Management knows this, which is why they're selling shares while the narrative is still hot. Institutional flows tell the same story. Top 5 institutions are buying, and 1,152 funds hold 58.8% of the float. That's a crowded trade. When institutions pile into a stock this aggressively, it's not because they love the fundamentals, it's because they love the momentum. And momentum stocks don't need fundamentals until they do. The second Neutron's development hits a snag, those institutions will sell just as fast as they bought. Now, let's apply the 10Q risk factor lens. Rocket Lab's latest filing lists 39 risk factors, up from 32 last year. That's not a typo. Companies add risk factors when they see new threats. What's likely in there? Let's guess. Concentration risk. Neutron is a single-point failure. SpaceX disruption risk. Starship's economics could make Electron obsolete. And government contract dependency. NASA and DoD are 40% of revenue. Management's PR team won't mention these in investor calls, but the auditors sure did. Here's the lab's PR verdict. Rocket Lab's management is selling a narrative, not a business. They're framing themselves as the end-to-end space company for the AI era. But the reality is they're a single rocket gamble with a cost structure that can't compete with SpaceX. The insider selling, the R&D burn, the institutional crowding, it all points to one thing. This stock is priced for perfection. And in space, perfection is a myth. Neutron succeeds, and Rocket Lab becomes a $200 stock. Neutron fails, and it's a $50 stock. There's no middle ground. What management is saying, we're the future of space infrastructure. What the lab hears, we're one test flight away from a reckoning. The momentum breakdown for RKLB. RSI sits at 74, pointing to overbought territory, signaling caution on new entries. MACD is currently bullish, with the histogram crossing above zero. Rocket Lab is no longer just a launch company. It is a vertically integrated space systems powerhouse. First, their spacecraft manufacturing division is capturing massive backlog. This turns Rocket Lab into a premier subcontractor. Second, the development of Neutron is progressing rapidly. Neutron is their medium-lift launch vehicle designed to deliver 15,000 kilograms to low Earth orbit. They already have 5 dedicated launch contracts signed. While Wall Street focuses on launch frequency, the real margin engine is proprietary component manufacturing. This vertical integration buffers them against the low-margin reality of commodity launch services. They build the actual buses and reaction wheels. Reaction wheels being motorized flywheels that control a satellite's orientation. This keeps their gross margins insulated from pure launch price wars. But here's what breaks the bull thesis. Rocket Lab is fighting an uphill battle against absolute gravity. Neutron is a massive $500 million development bet. A single technical failure during its maiden testing phase will trigger a swift 40% drawdown. Furthermore, the impending June 12, 2026, initial public offering of SpaceX will permanently rewrite sector valuations. This initial public offering, the process of listing private shares on a public exchange, uses ticker SBCX. If SpaceX achieves its Starship target of under $100 per kilogram to orbit, the economics break. Rocket Lab's launch model will be utterly demolished. At a forward P/E of negative 15,934.3 times, there is zero margin. This forward P/E, price-to-earnings ratio measuring current share price relative to per-share earnings, shows extreme valuation. New U.S. tariff policies are already inflating component import costs, threatening to compress margins further. Let's ask the one question that tech analysts and investor relations professionals whisper behind closed doors. Can Rocket Lab's Space Systems division scale fast enough to offset the capital expenditure of Neutron? Can they do this before SpaceX starves the commercial launch market? The lab's answer is a calculated yes, but with a massive caveat. Right now, Rocket Lab's spacecraft division is carrying the company. This division is supported by a $2.2 billion backlog. But the technical setup reveals a market operating on pure momentum, not fundamental safety. The RSI sits at a highly overbought 74.8. This RSI, Relative Strength Index measuring price momentum on a scale of 0 to 100, warns of exhaustion. The options market is heavily skewed with a bullish P/C ratio of 0.65. This P/C ratio, put-to-call ratio comparing bearish put options volume to bullish call options volume, shows extreme optimism. Retail is buying the hype of the upcoming SpaceX IPO, bidding up Rocket Lab as a proxy. But they ignore the physical reality of severe component import restrictions. Here is the bottom line. The lab's AI score sits at 66 out of 100. This AI score, our proprietary algorithmic rating combining technical momentum and fundamental health, represents a cautious hold. RKLB is currently trading at $135.76. It is testing its immediate technical resistance of $135.76. This resistance, a price level where selling pressure typically prevents the stock from rising further, is critical. We also see hard chart pattern resistance at $140. If the rising wedge breaks to the downside, expect a rapid retracement. This rising wedge, a bearish chart pattern characterized by converging trend lines sloping upward, is highly dangerous. Key support sits at $77.02. This support, a price level where buying pressure typically prevents a stock from falling further, must hold. Otherwise, the stock will plunge to the $74 level. The MA20 is at $104.87. This MA20, the 20-day moving average tracking short-term price trends, is far below today's price. Do not chase this run-up. Wait for a cooling of the RSI or a successful Neutron hot fire test before committing fresh capital. This is not a game of sentiment. It is a game of orbital physics and capital preservation. Rocket Lab's 66% score hinges on Electron's 98% launch success rate and NASA's $200 million integration deal. Is the bull case or bear case stronger for RKLB right now? Drop your thesis in the comments. We're not giving financial advice. this is for education. Do your own research. Past performance doesn't guarantee future results, and we could be wrong. Stay sharp. Until next time, stay curious and keep building.